So it looks like it's that time of the week once again. The same time where it looks like my laziness is kind of taking over, but at the end of the day, I try to recover it at the last minute. So again, it's a little bit of a late type of recording. Is Sunday afternoon, well, almost evening. It's 5:30 p.m. here where I do live, Central Europe time. Um, I guess this week kind of played out the way we were expecting. At least I was expecting it. And we are going to dive into, well, the economic calendar first, but really there wasn't a lot to discuss about it. If not, if you remember last week's video, the ISM services PMI coming in above expectations, as you've seen. And if you remember, I said, you remember the way I closed in last week video where I was like, don't panic out, try to be rational, don't take emotional decisions because, all it takes is just this particular data coming in a little bit hotter than expected, and you might see a decent bounce in equities. And we're going to look at the charts in a minute, but just, again, just to reiterate the fact that sometimes this stuff, although it is always impossible to predict with 100% type of accuracy, but it's like, sometimes you kind of have that gut feeling for it, right? So that's that's the data, and we're going to look at what the market reaction was. But I think all in all, this week was a little bit of the, we got the everything bubble, and now we've seen over the past week the everything bounce rally, right? A lot of stuff actually rebounded a little bit. So, it was a very interesting week, a little bit of a slow week for many, many reasons, but it might have been a little bit sloppy, a little bit unsure, a lot of different dynamics at play. But all in all, it was kind of in line with expectations, if you remember, again, last week video. Now, the usual suspect first. Let's have a look at starting out with currencies this time around, because of course the big talk of the week was the yen carry trade, which was unwinding, right? Now, I'm not gonna get into the dynamics of it because at this point, I'm sure you have heard about it. Up until the point you were blue in the face, everyone was talking about it. So I'm not gonna spend time repeating something which is already out. And I guess if you follow financial markets, you already know about it. You already know about the dynamics. The leverage, and how it was good for pumping assets prices higher, and now why it wasn't so good bringing asset prices down. So uh, what can I say is just that I think I've said in last week video that when you got such a huge deleverage event, you might expect it to be a little bit short-lived, right? It's not about really. uh, I guess even there was a little bit of a misunderstanding. People think that just because this is an unwinding, it has to unwind completely. Actually, no. I mean, you just have to liquidate or to bring to that point, to the max pain point, those people which are massively over leveraged, right? And of course, TradingView is just having a little bit of a hiccup here for who knows what reason. Maybe I got too many tabs open, but we have just lost the euro here. But anyway, we can see still the yen. So the yen had a little bit of a, again, the yen is the denominator here, so a little bit of a rebound in the pair USD JPY pair. So the yen kind of pulled back a little bit. And again, let's do it this way, right? So it pumped and now it's pulling back a little bit, which gave a little bit of a breathe, a little bit of a break to markets. As for the rest, you already noticed that the euro is gone, so we don't have the euro anymore. Thanks, TradingView once again. But if you've seen it before, the euro has been particularly strong, which is still something I can't really explain. I guess it's just a reflection of the yen strength, right? The yen goes up so much, the yen is a big component, as for the euro of the DXY index, so the DXY goes down, and conversely, the euro rebounds a little bit. Still, I don't I don't fully get why the pound is struggling a little bit here, following up the euro, but well, yeah. Uh, I guess I'll have to dig a little bit more into it. So is the unwind complete right now? I was reading reports and news and whatnot. It looks like, standing to Goldman, that at least 75 to 80% of the over leveraged positions have been actually unwound. So who knows? It might be that that spike in volatility could cool down a little bit, uh, as it did this week, and it might, you know, carry on, no pun intended, into the next week, right? But so far it looks like, kind of like the calm before the continuation of the storm, maybe. I don't know. I'm just making stuff up, but it looks like it calmed down a little bit. So we had the spike in volatility, and of course, things are actually coming back in line a little bit right now. Um, Looking at the DXY right here, we've seen that after tapping into the pockets above, it came back to the EQ of the macro range, went right through it, and it bounced around another relevant level if you're still considering the macro range you are in. So would you expect a little bit more of upside in the DXY coming into next week? I guess it depends. It depends on how the yen is gonna perform. Uh, on top of my head, I would say probably, yeah, maybe we might see a little bit of a pullback in the yen, keeping on into next week, and therefore Dixie floating around the EQ of the range. And I I don't expect next week to be kind of decisive. I think it's going to be kind of like this week. So a little bit sloppy, a little bit of a choppiness around, and we're going to look at it when we transition to indices and equities. But for now, you know, just try. Let's just try to establish this premise, right? We do expect a little bit of what we had this week, until, of course, proven otherwise, right? Just at the end of the day, it's just a matter of establishing a little bit of a baseline and then looking for signs and evidences which are actually confirming or denying that bias, right? Let's have a look at oil. And oil is another one, if you remember, again, and sometimes it's hard. It's hard to actually relate stuff which actually happened 6 days ago, 7 days ago, because everything is moving so fast right now in these markets with this volatility picking up that, even kind of reconcile the old, with what happened just 7 days ago. Sometimes it's hard, but if you remember, I said, oil seems a little bit weak right here, but just be careful, blindly shorting it, because you never know what could happen with oil. It could move in a very, very erratic way, especially considering what's going on in the Middle East. And, case in point, we got a massive pullback in oil to the upside. It stopped, closed on Friday, right at the edges of the previous range we were looking at before. So again, I said, even if the final destination might be down, expect a huge amount of volatility right now. I mean, not only in oil. If you now think about it, and you're going to see it, as long as we are going through all these charts. The theme of the week was basically mean reversion. It's like, price goes out, throws back in. It goes out, it throws back in. It creates an imbalance and then it rebalances. So it's all one and the same. If you look at many different charts, let's look at Bitcoin for instance, right? We had a massive dump, 1, 2, 3, 4 days of a dump starting on Friday, August 2nd, right? We dumped from the open. Let's look at it. What the apex of it was 25% dump, right? And from that we bounced back, measuring at extremes 28%. I mean, that's a really huge drawback, right? you know, but at the end of the day, the extension was particularly violent. So you do expect the counter reaction, the quoting OG again, the boomerang effect to be at least as strong as the initial push you had. It doesn't always happen, but I would say, in the majority of the cases, just kind of be on the watch for it. Because as long as the markets can be relatively efficient, you're going to have something like this happening more often than not. As long as you don't see a particularly huge liquidity event where basically the floor just breaks and you don't find any buyers below market price, but as long as you don't have liquidity constrictions, this is what you should expect, at least in the short term, right? Now, of course, if you expand the chart, if you look at different time frames, things might be relatively different, might look more severe and whatnot, but at the end of the day, overall, the dynamics are always the same, right? Price goes out, throws back in. And it is actually kind of relevant, the level at which, or toward which it drew back, because we were looking at this level right here, right? When we got the flip of it and then the semi retest of it because before pushing higher, and then the final tap of it before bouncing it off of it and then smashing through. And now it looks like after this huge dump we found resistance at that very same level. So there are levels which are particularly relevant and they're gonna stay relevant for a good amount of time. Now, of course, eventually the liquidity will shift, and the levels at which liquidity can be found are going to be different. But if you find a good level, if you identify a good level, just because it has been tested and then flipped, whatever, up until the point price gravitates around it, I would say just keep it on the chart because you never know. It oftentimes is going to be relevant, so give it at least like 2, maybe 3 times where the level is traded at or around before actually discarding it completely and saying, you know what, it's done, it's gone, it is in the past now, I'm not paying attention to it anymore. As for the rest, I think it's going to be particularly interesting to see if now Bitcoin can actually stabilize itself around this level and maybe try for a little bit of an upside, which currently it's not really my base case, to be fair. I could be wrong on it. I mean, I'm wrong all the time. It's not an issue for me, right? Or I make it black because I really despise that color. What is pink? No, black. Come on. Or what you could see, it is a little bit of weakness into it. We extended, we drew back, and it might be that now we got continuation to the downside. Maybe. I'm saying, that could be just one possibility. And, having to pick right here, right now, I'd say that maybe a slow grind to the downside, but I still think, looking at the overall spectrum, I think that might be, I would say 60-40, like 60% odds to the downside and 40 to the upside, maybe. And again, you still have this level which could be relevant, like, and now at this point, I think maybe this one, it's even more relevant. Like, if you see it it can reaccumulate a little bit and pushing high, reclaim this one, and then try to test this one. That would be the bullish scenario if you really want to be bullish. I'm struggling a bit being bullish right now, considering what's going on. But again, it's just a matter of coming up with hypotheses and trying to validate them or negate them. So I guess it's not a matter of being right or wrong. It's just a matter of having a plan for both scenarios and try to have a little bit of, you know, again, a plan to make money on both sides. Sometimes it doesn't, sometimes it's like you might have an initial bias and then it is negated, right? What's going to happen? Maybe I took a loss. So if I look at the odds, I was attributing, like in this case, maybe 60-40 odds. Now, if I can completely erase from my whiteboard the 60% odds of price going one direction, I can bet the all on price going to the other. If one door is closed, the other should be open. It could be a little bit like that. I can promise you it's not going to always work. Sometimes you might just have price dancing around and just going anywhere. And at that point, you really need to be nimble and to realize very very soon that price has been kind of captured into a trading range. And if you have let's say a direction oriented type of a strategy, you know that there is no clear trend, so you should be sitting on your hands, right? But I just wanted to leave all the doors open, right? Just again, I'm not forecasting. I'm not saying it's gonna be this, it's gonna be that. I'm just saying, if you see these, then it might be that. So always have a baseline, a base case, and be ready to see it invalidated and negated, and be ready to shift in the other direction. Okay, that's the name of the game at the end of it. It's not about being right. It's about making money. Okay. Have a look at gold. Gold behaved particularly well. Actually, if you getting back to last week, it actually retested. It actually retested the area I was expecting to be retested. Nice week into it, and then it actually retested it once again, and then it put together a decent bounce. It's not, of course, it didn't make new highs, and we still have, I don't have it anymore, but we still have that thing about, the RSI building up a little bit of a divergence. But, again, for now, I don't have any particular type of worries about gold. It looks to me like it's slowly grinding higher. And beside that RSI divergence type of thing, I think that should be the path ahead. And still, if you remember last week, our point of invalidation was the key of the range. Now you might say, if you got long positions into gold as I do, now you could bring up the invalidation point to here, right? Let's say this is to be considered a high low. If it gets negated, your bias should flip, or at least should shift from, let's say, bullish to at least neutral, right? I'm not saying as soon as it breaks this low, go there and liquidate everything, but at least, be prepared for a little bit of a change in behavior, right? That should be your first warning, I'd say. So other than that, I think gold is still good for now. And one funny thing about gold, because I was discussing it just this week, and everyone is talking about gold. It is an inflation edge, and gold is going up because you know the market, it's kind of forecasting inflation to get out of control and whatnot. Because although we might have a temporary slowdown in inflation, as soon as we got policymakers stepping in next time, when the next crisis hits, you're gonna see gold skyrocketing because they're gonna QE to infinity, lower rates to negative territory and whatnot, money printing as you've never seen before, and so gold is your inflation edge. Okay, maybe. I mean, I get the point that gold is good at at least maintaining your purchasing power over the long run. No, I'm not disputing that. I'm not trying to throw Peter Schiff under a bus, but just if you want to talk about inflation edge, just have a look at these. All right, this is basically putting in $41.42 into gold in 1900 and putting the same amount of dollars into the stock market at the same time. In 2020, if you put that into gold, you would have $3,656. On the other side, conversely, if you put that into the stock market with all the ups and downs, the volatility and whatnot, but after the same amount of time, you would have 30,000. Well, let's round it up at 31K. So it is so funny, but because when you start to, uh, I don't want to say fight, but when you start to confront these gold bugs, yeah, stocks they don't have any underlying, they don't have any fair or not fair value, intrinsic value, whatnot. Yeah, okay, but are we talking inflation edge? These are the numbers, right? So I mean, buy all the gold you want, but I'm, I'd rather buy stocks at this point. I mean, standing to this chart, right? So is another one of those narratives which have been pushed. And I think, you know what? I think those people calling for doom and gloom and saying you should buy hard assets because there is no tomorrow, is going to be Armageddon and whatnot. I think the majority of them, not all of them, of course, like any other things in life, right? It's not all black and white, but I do think the majority of them are just trying to sell you a narrative because they do want to sell your product. In this case, it's gold, right? So again, just try to make your own researches every single time on any single asset you want to invest or you want to trade because sometimes reality might be a little bit different compared to the narratives you see going around on the internet. So I just thought that was interesting. I found it online and it was, sometimes it could be a wake up call to someone, so it's always interesting to check because I think people always take things at face value and it's like nobody takes the time to check the obvious or at least the perceived obvious, right? Hey, I've heard all my life gold is an inflation edge, so I'm gonna buy gold if I am expecting inflation. No. Actually, I mean, this is not to say that gold wouldn't have protected you against inflation over the long run, but was it the best alternative you had? So, from an investment standpoint, if you are seeking alpha, just do the math, right? So that was it for gold. Just a funny thing. Let's look at, well, there is not a lot to say about bonds. They were particularly overbought. There was this huge extension to the upside while we had the carry trade unwinding. And what does it happen when you have an extension? Well, you got the extension fill. They close on Friday on a little bit of a bounce. I I would expect them again. I mean, this could be a little bit biased, but I would expect them to trade higher again. I'm not saying tomorrow or on Monday or maybe on Tuesday, Wednesday, but in the coming weeks to trade higher again. Basically because I am expecting yields to go all over. So that would be my expectation. If you check yields, of course, it's just the reverse, right? Yields pulled back to the upside after the dump. There is the inverse relationship. So that was it, at least for the first part of the charts. Now let's have a look at equities. And now beyond the squiggly lines. I'm gonna get there in a minute, but if you remember, now this is a little bit of a head scratcher because I was talking about, when the markets were closed, right? And I said, you know what, the market is down, so just don't panic out on Monday and go sell everything you got in your portfolio. Do not go buying puts at this point because it's a little bit of a nonsense at this point. You know, the premium you would have to pay would be so high, and if you want to sell your holdings, you risk to puke the lows, right? And at the end of the day, actually, we had that little bit of a bounce. Now, it was scary. I'm not saying it wasn't, because from Friday's close to Monday open, like, the Qs went down more than 5%. The S&P from Friday's close to Monday open was down 4%. So, you wake up on Monday morning and you see that. I can understand people panicking, but at the end of it, what happened? The market just rebounded. And again, it was sloppy, it was choppy a little bit, but we had that rebound throughout the week. What's interesting, I'm going to show you now. Throughout the week, I was sending out a little bit of updates and whatnot. I constantly look at what my trading Discord mates are thinking. And in here you see people discussing about, ranges and extensions and ranges being rebalanced and then whatnot. My only contribution to it was, I'm just a simple guy, so I'm just looking at stuff and patterns repeating themselves over and over. I was updating my thoughts on what I thought could have happened, and of course, they are very short-lived because you try to assess stuff in real time, day by day. But to have a little bit of a recap of it, I'm gonna show you to you. Well, I'm gonna show it to you, should I say, right? So that was it. Now, at the beginning, I was like, okay, so maybe the S&P, these are E-mini ES futures. So I saw this level and I said, you know what, we failed to reclaim it. We went down. So as you've seen in the past, in a downtrend, it might be it, right? That's done. We are going down. The momentum is still to the downside. Then we actually didn't trade for new lows. I was expecting basically these, right? The market to trade to this level and then going down, and the S&P to basically feel SPY in this case to feel the gap, retesting the 100-day moving averages and then dump from there. We kind of had it, but it didn't have continuation, so I had to reassess that. So this is where you see SPY retesting it and selling off, as you can see in here, right? Okay. IQ didn't really reach that. It was so weak. And again, if you go back to last week videos, again, I talked a little bit about relative strength and whatnot. So NQ or the triple Qs expected to be a little bit weaker. So that was the thing I got wrong initially. And now, I reassessed it and say, you know what, we touched into the level, but we didn't have continuation, and we actually traded higher, retesting that same level once again. So could this be that, as you've seen in the past, the market was particularly efficient in basically filling in and rebalancing all the gaps that were left? So it might be that we need to trade higher before going lower. It is just, a potential scenario. It's not like this is what I think is going to happen, and therefore this will happen for sure. Again, it is just about making hypotheses and then seeing if they're playing out or not. Because if you see it playing out on a larger time frame, then you can readjust it and trade in that direction with that underlying premise, even if you're trading intraday. Okay, so uh, that was basically my aim with this type of analysis, right? And then I was saying, you know what, if you don't have the dump from these levels, and if you see the market reclaiming these levels, if you want to play it on the conservative side, you can say, you know what, I'm going to give out, I'm going to stay out of the market and giving out a good 5 to 6% type of a bounce, but I might want to step in and resuming buying into it after we reclaim a decent level. And still, from that point onwards, if I want to bet on the upside, I still have a little bit of a 5% back to the highs. And considering the highs were put in at and around 5,700, something like it, you might say, next destination should be big figure at 6K, and that would give me an additional 5% return after the highs. Again, would I put a dime on it on my own money? No. But it is also true that my average trade duration is about 10 to 15 minutes. So I'm not trading these big swings, which happen basically over 1, 2, 3 weeks. No, it was just to kind of have a little bit of a bias going forward, right? So that was the thought process throughout the week, just to as a testimony that sometimes you see things, sometimes you think about things, but then again, the market is always there to either confirm or deny. And you constantly have to reassess what's going on in real time and make adjustments and reevaluate decisions and readjust, recalibrate your expectations and whatnot. This is just what participating in a market might be from time to time. It's a dynamic environment. It's never static. It constantly changes around. So I finished up the week thinking of, you know what, if what I was thinking and postulating for futures could be true, at this point, what you could see is actually these markets being pulled into these cross. Like, if you look at SPY, you got the 20 and the 50, talking about moving averages like here. So it's not uncommon. And this is one thing that I've learned relatively early in my trading journey about these, when you got crosses like these, it's not uncommon to see price being pulled into them and then seeing a massive rejection. So it's kind of like what we had in here with the triple Qs, right? You see the 20 days moving average approaching the cross to the downside over the 50 days moving average, and you see price being pulled in, price is rejected, and then the two actually crosses. So these pull can be happening a little bit ahead of the cross or a little bit after it or at the same moment that the cross is actually happening. It's a little bit of a it's just to identify a little bit of a range of an area where you would expect these things to happen. But still, it's just trend analysis at that point, right? uh, we discussed what what are moving averages, right? They are just averages. So, you know, again, it's not the Holy Grail. It's just another visual representation of what could happen. And even if you don't want to trade the actual, let's say, move unfolding itself, you could still say, you know what, I don't care what's going to happen on the daily time frame like these. I just want to see it being confirmed, and then I'm gonna, let's say, hunt for shorts if it is confirmed. I'm gonna hunt for shorts on the 5 minute time frame over the next few days or weeks, because now I have a strong signal and a strong bias one direction or the other. So ultimately, I think it wouldn't be uncommon to see something like this playing out and price eventually having a little bit of a bottoming formation at and around the 200 days moving average, which at this point it should travel back up if we, unless you don't see a real crash in it, but if we can trade again a little bit choppy at these levels, a little bit sloppy, it could take a little bit of a time, and that would give these moving average time to catch up. Maybe having a little bit of a higher low, so working on a higher low before actually trying to establish a solid and tradable low to then, being long at, or after it is confirmed. So that was the thing, especially because, after, while we were seeing these markets coming up, you've seen volumes are actually ticking down. Again, the RSI, it's still at the exponential. I guess a good type of scenario should be the RSI actually making a little bit of a higher high right in here, the same as here, right? See the RSI making a higher high compared to this high right here and right here, and at the same time price being unable to trade above this high and to trade above this high right here, while the cross, or in this case one of the two, it could be the 50, it could be the 20, one of the moving averages or the cross in this case would reject price. At that point, what you would have is your continuation type of divergence, right? So currently I'm looking for it, or at least, it's not that I'm wishing that is going to happen. I'm just, I'm saying, what, depending where we opened up next week, I'm willing to take longs up until we reach these inflection points. And at that point, I might want to take a step back and reassess things a little bit if I'm trading with a bias and if I'm trying to capture big swings one way or the other. Okay. And here we are just looking at the same things. It's actually the same drawings, both for the NQs, ES, and the Dow in this case. So this is just redundant. Um, and again, this is redundant again. Now, one thing about equities, we've seen, talking about big and major pullbacks, we've seen the Nikkei. Look at the Nikkei. On Monday, from the weekly open on Monday to the ultimate low, it was down 12%, just to be up again almost 14% on Tuesday. It's a hell of a lot of a mean reversion there, a hell of a lot of a boomerang. And even the Nikkei actually closed the week on a relatively, uh, I know it's hard calling a relatively healthy upside move if you if you're looking at where it was coming from, but in the overall context, it is just a pullback to me at this stage. Uh, oh, same chart. Still SPY, but this time around I had volatility. So we had that big spike in volatility and confirming that, the pullback was actually happening. We had a contraction in volatility, getting back down to the levels where, yeah, basically to the breakout levels. But that's the thing with volatility. It expands and it contracts and it goes on and on and on. So this was basically what happened, standing to the charts. Now, uh, if you look at oil, a little bit of a step back. Oil came back up. So my fundamental focus, the break evens, I'm constantly looking at them. They came back. They came back up, of course. They bounced a little bit together with oil, of course. Nothing relevant, by any means. It's like you remember when we were looking at it right in here, and we were saying, yeah, they bounced up, but they didn't make higher highs, so the risk is still to the downside, and of course, we got that. Again, adding another piece to the oil analysis, can look at oil futures and a different expiration. So you can see these are the September expiration, October, November, December. What is interesting is that basically you got 76.98 for September. October is at 75.70. November is at 74.85. So basically, if you look down the curve, the oil market, the futures for oil are actually pricing in lower oil prices going into the futures. So over the next few months, that basically is indicative of, again, disinflation, and of course not growth, but the opposite scenario. So still the fundamentals, if you look at oil in isolation, are still on the bearish side for the economy. All right. Now again, as I said last week or in the beginning of the video, don't be misled into thinking that just because these fundamentals are actually suggesting one thing, it's going to happen tomorrow. When you talk about macro, it takes a lot of time. So sometimes we're talking about weeks, sometimes you're talking about months. So, you know, fundamentals might speak one way, but the market, in terms of price, it's going to take its time to digest these stuff, to actually elaborate them, to process them, and to actually reflect them in the price action. Just take all this stuff. When I looked at the FX calendar, what the economic calendar, the break evens, the curves on the oil futures, or even the yield curve, right? Take them as a sort of a guideline, which are indicative, for the most part, I would say, about risks. Okay, they're not saying what's gonna come, and when it's gonna come, but they're mostly saying, look, although what you see in price might look good, these are the risks. And this is what the market is trying to, well, not really predict, but to hedge themselves against. So just pay attention to it and just put it on your radar, so that when you see price action on whatever asset classes you're trading, if you see price action confirming it and coming back in line with these indicators, macro indicators, leading indicators, you know that the risk that was kind of signaled, it's now manifesting itself. This is all this is, right? It's not about making a prediction for tomorrow or next week. It's just about being sure of how you are assessing risks at the current moment in time. Not much to say about the yield curve. We are still uninverted. We are flirting around with this uninversion. So it's not conclusive yet. I think again the uninversion will actually start when the Fed will finally cut rates. But on on the same type of logic, we could have a look at the near-term forward spread, which is still inverted. So again, this is just another measure. I'm not going to read all of these, but this is a measurement that Jay Powell was looking at months ago. When he was forecasting, we're not going to have disinflation. We need to be hawkish because inflation, we are really taking the risk of inflation being entrenched. And I do remember that, like, 1 month after he was talking like this, the near-term forward spread actually inverted, signaling again that interest rates in the future would have been lower than they were at the moment he was speaking of. The same type of stuff. So again, it is just another fundamental indicator. I was just having a little bit of a look at it. Normally I'm not looking at it, but I was just scrambling and looking at different type of macro data. Same as I was looking again as last week at the credit spreads, which same as volatility. Let's have a look at this. we had that massive spike, right? On Monday when we got the carry trade unwinding, and this is the end of the world type of thing. But if you look now, this is updated to August 8th, it looks like. Yeah, Thursday. So we lack the data from Friday, but basically, if you consider that on Monday was around 3.93, Thursday 3.48. So a little bit of a pullback in here as well, kind of like in the VIX. Again, it's still always a measurement of the perceived risk you got in markets right now. One thing which I was just looking at actually this morning is copper. Now, copper, which some of you may know or maybe not, Dr. Copper. And the reason why it is the nickname is Dr. Copper, it's because it's a good thermometer of the quote unquote global economy when it comes down to growth or to economic expansion. Because if you think about our modern and current economy, a lot of stuff are actually digital, and we do rely a lot on electronics. And pretty much, I would say, I'm just making up numbers, of course, just to get the gist of it, but I'd say 60 to 70% of the industries right now actually need in one part of the manufacturing process a little bit of copper. So if copper prices are going up, that means that there is demand for copper, and that means that we are ramping up productivity and the production, we are scaling up, there is demand, so we are actually buying up more copper because we do think that we are going to need that in order to produce more stuff, more things to then sell out in the real economy because there is demand. So if copper goes up, that should be usually good for the global economy. When you see copper going down, on the other side of things, that should be bad. And I mean, you can track it and you can see, ahead of the 2008 crisis, copper plunged. Then you have a little bit of a double dip recession just 2 years after it. Copper just went down. You can look at 2018. Curiously enough, in this period right here, there was that complete twist from Powell, which was actually hiking rates, and then he had to revert course because at the same time copper was going down, and we almost had a recession in 2018, 2019. Then of course 2020, look at that, January 2020, copper went down, but standing to the media, the COVID pandemic actually hit the US only in March, February, March, but copper was signaling something was wrong in the economy with a little bit of a month of advance, right? Then again, you see, we got 2020 massive reflation, and then throughout 2021, 2022, China reopening it, whatnot. And then in the middle of 2022, you do realize that China reopening is a lie and copper just crashes back down. Now, this wait a minute. My tongue is kind of twisted right now. All right, so recently we have seen this massive run up in copper, but if you do a little bit of a research, you're gonna know that I'm not gonna say all of it, but a good chunk of it was a problem on the supply side. That means that a good chunk of copper producers, miners, or call it what you like, they reported problems in the extraction process, in the mining process, and they were kind of sending out reports about their crippled ability to extract copper out of the ground at the same pace. And at the same time, China, which is a huge copper buyer, was stockpiling copper just, on the wave of this news because, they are the industrial powerhouse of the world. So they are one of the major copper buyers because they need a lot of that, right? So on the one side you got supply being reduced, and on these alert of supply potentially being reduced, China was stockpiling it, and we got an imbalance in between supply and demand, and copper actually went up like this. But it picked, and now it's coming back down. When it comes down, of course, as I said, it's not a good sign for the real economy because you would expect copper to be up. And so I was looking at these, if I can load it up, the copper to gold ratio. This is particularly interesting if I can load it up, of course. Looks like I can't. Like, yeah, I can actually. To give it a little bit of a room to breathe, let's just try to close down a little bit, a few tabs here and there. Okay, we got it. So you can see that you can read the interpretation of it. I'm gonna kind of pause a little bit on the description if you want to check it out. But basically, if what we've just said about copper and copper going up being a good thing for the global economy, at the same time, you should expect when gold goes up, that is a bad thing, right? When, when people do buy gold on fear, basically. So could be whatever type of fear, but gold is no one liability. Gold is the safe haven, allegedly. But anyway, that's what the markets almost more often than not they do think like that. So the copper to gold ratio could be a good thermometer about how the global economy is actually performing. You would expect, of course, since this is a ratio, the more it goes up, the more positive it is. And when it goes down, that just means that gold is going up at a faster rate than copper is going up. Or actually, gold is going up and copper is actually going down. You name it. Now, we got another chart, and these are just the two assets compare one to the other. So here we got the ratio, right? And here we got the two assets. What is particularly interesting about it is that this ratio actually has a good relationship with what? Oh, interest rates. You wouldn't say, right? So what's that? 10-year US Treasury bond yield. So are you telling me that this ratio, if it goes down, the global economy is slowing down, so the 10-year yield is going down because it's pricing in not future growth and inflation expectations? Do they move so accordingly? I mean, look at the relationship in here. And now you are looking at a little bit of a divergence with it, right? Copper to gold ratio is going down, 10-year has been up. And these ties a little bit in that dilemma we were discussing about, the Fed wanting to keep rates so high for so long, and at the same time, Bill Dudley saying rates are too high. The economy can't sustain that. Now, based on the past, I'd say when you got a divergence like this, and given all the other macro data, I would still bet that if these two things are going to converge, it's going to be because the 10 years is going to come back down, not because the copper gold ratio is going to go up. At least that would be my interpretation of it, if I have to bet at this current moment in time. And I mean, I don't really have to Sweden the peel a lot, because you do know that I've always said interest rates are going to go down, in my humble opinion, of course. And this is just my opinion. It could be different, or it could be wrong. Yeah, again, and if I'm wrong, that just means that I'm gonna be out on my TLT trade sooner than expected. But again, what's that? Oh yeah, I was looking at a bunch of different curves right in here, but it looks like it just been fucked. So again, this is basically what I was looking at this week. Um, I was also thinking about talking a little bit about, let's put it this way. Now you can see the copper gold ratio compared to interest rate swap spread. Um, I'm digging a little bit into it in these interest rate swap spreads right now. I I had a few charts. I had a few slides, let's say, ready to be shown up, but I thought after a little bit of a consideration, you know what, I'm not gonna take the time and the effort to talk about something that I'm not really feel comfortable explaining to others because I still feel like I'm not fully get it. Uh, I I do know the mechanics of these swap spreads. I do understand how they are calculated and how they move, but it would require to me a little bit more of a time to actually put together some organized thoughts to then being actually spoken of. So I just decided to leave them out. But just for the sake of it, um, you can see that basically these swap spreads that they track the copper to gold ratio pretty well. And without getting into the details, if you see the spreads going down, that is bad. Okay, it's bad on many different levels. It's bad on one side. It's bad on the balance sheet capacity and the ability of the dealers to provide these contracts because these are derivatives contracts, of course. And it's bad because it manifests the intentions on the side of the other part of the market, so the demand side for these derivatives contract, to hedge themselves and to hedge themselves against rates going lower. And again, rates, yields going lower, it's not good because again, yields, interest rates are a function of future inflation and growth expectations. So it might be that next week I could allocate a little bit of a time talking about these swap spreads, but for now, no, I don't think I will because I feel like I would make a disservice to people. So just let's just leave it at that. As for next week again, um, I do expect the market to keep up these bounce a little bit more, and really my crucial areas would be these for SPY, and basically these for the Qs, and from there I'm gonna reassess. I think again that this is not the time to take emotional decisions. Um, Many people probably de-risked on these bounds because they felt unsure, because they wanted to see how things are actually going to play out, and mainly because on this dump, which if you think about the US market, and you look at the gap, right? This dump happened overnight. So if you were in the US, you went to bed on Friday night and the market was here. You woke up on Monday and the market was here. So as soon as the market bounced up, a lot of people actually said, you know what, I want to get out on these bounce. I want to get out. I want to mitigate my losses. I don't know what the fuck is going on. I don't know how long it's going to take for the market to come back into balance. But for now, I just want to be on the defensive side and I want to be out. And then I'll see, right? So I think that's the main reason that there were what are called trapped longs in this area right here. I mean, people which were long and they didn't have the ability or the possibility to sell and get out of the market because the market just kept down and they were asleep when all of this was happening. So they had to mitigate on this bounce. Again, combining it with the carry trade, which is unwound, maybe not completely, 50%, 75%, 80%, we don't know. Could could keep on unwinding itself even more. Maybe we don't know, but these are the things we are looking at right now. We these are the dynamics, the movements, the price action we're looking at right now. And for me, getting into the next week, my stand is going to be that if I had to engage into something particularly relevant, I would like to trade the market at least around this region. There's going to be an inflection point. So whatever comes out after this test, if we can have it, because it's not granted we are going to have it, but if we can have it, I'm going to see how it unfolds, and after that, I'm going to establish my line of action, my course of action, and my intraday activity. So again, 1 hour mark, a little bit of a long video today. I apologize for it. Also because it's going to be a late video, it's probably going to load it up in an hour or so. But anyway, those were my thoughts for the week. I tried to add a little bit more with this gold cooperation, whatnot. And maybe, who knows, next week, if I got the time to dive in a little bit more into the interest swap spread, I'm going to try to discuss them. For now, I didn't feel comfortable, didn't want to make anyone a disservice. I think there are many other people which can explain that better than me, so just Google that or search it on YouTube if you want. Just bear in mind those are very important. Together with yields curve and credit swap. Sorry, yeah, was it credit? I forgot the name. Cred wasn't. Yeah, maybe credit swap. Yeah, as credit swap, so interest rate swap are relevant as well. Now, as you might notice, I'm starting to losing it because I challenge each and every one of you to speak for an hour straight in a language which is not your own and trying to make sense of it. So at this point, I'm going to leave it at that. Have a good start of next week. And as usual, whatever you do, be nice and be cool. Niels out.